Hi, and welcome to Your Money Matters. I am Angela Gerard, your host. And today I've got Clint Lee with me. Ted Bauman is on a well-deserved vacation this week. And what a week to vacation. We're going to get back to that in a second. But before we get into it, I did want to remind everyone that Clint has his very own research trading service. You can get more information in the link above. But I definitely invite you to watch today's video because you're going to get more background into how it works. But it is on such a tear. He closed something like almost 24 trades in a row that were winners. It's incredible. Clint, I know you're not going to brag, but I'll brag for you. It's incredible. So make sure that you check out the details. But looking back at this week, the volatility has just been absolutely insane. We've had a number of things going on. We had the Evergrande debacle, the Fed meeting, China's cracking down on crypto again, and it's just all added up to markets on a roller coaster once again. But Clint, I know you have a different take on all of this, and I know I'd love to hear it. And I'm sure the folks watching would like as well.
Yeah, well, first off, Ted did choose one hell of a week to be out. That's for sure.
Thanks, Ted.
Yeah, I mean, so I know you routed off several events that we had this week. I know everyone's natural tendency is to look at what the market's doing day to day and to try to associate it with something that's in the headlines. And yeah, that's influencing the ups and downs to an extent, but you have to take it a step further to understand sort of the dynamics and the market structure behind the scene and how money is moving around in and out of stocks or among different asset classes. And that's the key point I really want to drive home today, because when you look at how investing and money management has evolved, we are now to a point where computers are now managing more money than people do. I'll say that again. Computers are managing more money than people do. And I've got a chart just to illustrate that. And I put these figures together. This is showing of the 31 or so trillion dollars in public equities, what's being managed by certain entities. You can see that the single largest source of management at 35% or just over 35%, they call it automatically managed funds. So that's getting back to sort of this computer-driven strategies. At 35%, that is nearly $11 trillion. Wow. That's being shifted there. So that's one thing to frame up when you look at how these big day-to-day moves that we've been seeing lately. They're becoming more common, especially sort of these cascading declines. And the one thing to understand is that with computer-driven strategies, with algorithms, speed is key. These things are built for speed. The profit opportunities are those that can react the fastest. And so because of that, we're seeing these algorithms just coming in and influencing the ups and downs of the markets. And I got one chart just to illustrate that, how quickly on Monday earlier this week, I think the Dow was down as much as 780 points or so, but just how quickly we reached capitulation that day. So here's a chart that just shows over the past year or so, the average daily change in the S&P 500 and how much we varied from that average number. So this is a Z-score. So once again, this is looking at what the S&P's done on average over the last year, just on a daily basis, and then how much on a day-to-day we move above or below that average. And a 2 standard deviation event, so 2 Z-score, the 2 standard deviation event is a very, very significant event, and we hit that on Monday. We've only hit that one other time this year, and so it goes to show once again how quickly that move down on Monday was. And now this is where you start to get into how computer-based and quantitative strategies can drive that. A lot of them use some sort of volatility as an input to their investment process. There's these volatility targeting strategies. Sometimes you hear to them referred to as risk parity. But the key thing is that when price swings in stocks start to pick up, they tend to move out of the market. And once again, it's the speed at which they move out of the market is key. And so you get these feedback loops coming in. And just to show you a point to this, one measure of volatility is a VIX index. A lot of times it's called the fear gauge. It's just a measure of implied volatility for the S&P 500. but when it's, it tends to pick up on the downside. And so here's a chart of the VIX index going back to the end of last year. And I've put arrows on all these spike ups. What ends up happening is that when you start to get these spikes up, all these quantitative strategies rush to the exits. They rush to sell. And so this creates this feedback loop where selling pushes up volatility, and it keeps on going, but it can work in reverse as well. That's why we see these, like this week's a great example. We see this quick drawdown in the market, and then all of a sudden we've had this big rebound. As volatility collapses, these strategies, algorithms rush to get back in, and it quickly pushes prices back up. And so, what's the implication of this for investors? One is that we've seen sort of these cascading, waterfall declines have been becoming more common. So, using that waterfall decline definition, last chart here, this looks at all those waterfall declines going back to the 1920s, I believe. And the key point here is that these quick, sudden declines in the markets have been becoming more common. I mean, if you look at recent decades, in the 80s, we had one instance of a waterfall decline. In the 90s, we had zero. But you look more recently, we had, in 08, the financial crisis. In 2011, that was the debt ceiling, actually. We'll see if we have a repeat of that coming up. But then in 2018, 2020, so I mean, they're becoming more frequently, they're becoming more spaced closer together. And so, this is the impact that, once again, just how computer-driven trading has grown, it's having on the markets. And that's what's happening behind the scenes with these quick drawdowns, these quick rebounds as well.
So we're fighting against computers here, which seems very daunting. How do we stay one step ahead?
I think, once again, it all comes back to just understanding the market structure and the dynamic that's at play here. And when you say computer trading strategies, that's just a blanket term. There is so much that can fall under that umbrella. And we talked about volatility targeting strategies just a moment ago, and how that can drive big ups and downs in the market overall. But there's also factor-based investing. So it's ranking a universe of stocks based on some metric that's been proven to pinpoint stocks that outperform. It can be something like stocks with high momentum, stocks with cheap valuation, stocks that look attractive on a profitability or quality standpoint. There's hundreds, if not thousands, of these different factors out there, and they can swing individual stock prices around a lot. There was something that happened earlier this year with an ETF called MTUM. It's a momentum factor ETF. It is a $16 billion in AUM, and when they did a rebalance to go back into the top ranked stocks based on trailing momentum, they rebalanced 68% of their portfolio. So 68% of 16 billion shifting into different stocks, out of certain stocks. And that's just one fund, one factor. I mean, think about all the money that's out there trading these strategies. So to stay one step ahead, I think there's two issues for investors right here. One is, how do you anticipate? How do you anticipate where the market's going to go? How do you anticipate which stocks could go on to outperform, underperform? And unfortunately for that, you have to roll up your sleeves and do the work. There is just endless amounts of data, of academic research that's out there around all these strategies, whether it's factor-based investing, risk parity, and so on. It's readily accessible. You can read about it. I know it's pretty heavy and it's pretty detailed, but that research is out there. That's how you can kind of learn about how these factors work and how that capital is being deployed. So that's how you can anticipate. And the other issue is, what can you do to protect against some of these sharp ups and downs, especially the downs that we see in the market that have been becoming more frequent. And one of the ways I do that personally in my portfolio is with options. So when I look at my portfolio, I like to split it up into buckets. I have my long-term sort of retirement money, but then I also have shorter term, more aggressive trading strategies. that I try to make sure is kind of diversified, uncorrelated to what I'm doing in other buckets of my portfolio. And so there's a couple things that you can do there. One is that with options, I mean, you can make outright bets on declines in the market. Put options allow you to make directional bets on the downside if that's a concern. But probably the other big thing is the risk management side is really where options shine, because I know with my options premium that I pay, that is the most I stand to lose. If I were to just outright buy a stock, I might have best intentions that once it hits a stop, if I target to lose no more than $500 on a trade, it could blow through that stop. I could be lazy, not paying attention to it. I could stand to lose much more than what I intended to. But if I spend $500 on an option premium, I know that is the most I stand to lose as part of that trade. And so that's a way to incorporate sort of risk management and bets on the directions of the market using options, to take advantage of what you're seeing out there with these quantitative strategies.
Yeah, and certainly a safer way to play the downside. As you mentioned, when these things go down, they go down. And if you're shorting that stock, then good luck. Now, you did mention that it takes a lot of research and a lot of reading. Personally, I would rather read a phone book than to go through all of that information, which is why I always recommend that people check out Clint's research service, Flashpoint Fortunes. Save yourself the headache. This man knows what he's doing. It is a quant-based strategy that he uses, and he's had incredible success with it. So again, make sure you click the link above for some details on how it works. Clint, thank you so much. And I'll speak with you next week.
Thank you.